everyone, welcome back to my channel, and in this video we'll be talking about depreciation. Depreciation is the reduction in the value of an asset over time. It's a non-cash business expense that is allocated and calculated over the period that an asset is useful to your business. So depreciation is basically a way in which we reduce the value of an asset over time. One fun fact about depreciation is that we don't apply depreciation to land because the value of land usually increases uh, depending upon the market value. But the other assets, for example, machinery, furniture, and fixtures, the value decreases because we use it. And if we go in the market and sell some used items, so of course the value of the item would be reduced. It's a non-cash business expense. That means is even though this is an expense, we don't physically pay it to someone, but we do show it as an expense of the business. It does come under profit and loss. So that's the reason we call it a non-cash business expense. The calculation for depreciation is done in relation to the useful life of the asset and the usefulness of the asset over a period of time. So there are so many reasons to calculate depreciation. So first of all is to reveal the correct profit or loss for a business. Because we are using the asset to generate a revenue. So using the life of an asset is basically an expense for the business because it's reducing. So we need to know the correct profit and loss for our business is the reason we calculate depreciation. The second one is to know the correct financial position of the business. So if you want to know the financial position of the business, you would go and see the balance sheet. In the balance sheet, we do have assets. And if the value of the assets is not correct there, we can't see the correct financial position of the asset. So to calculate the correct value of the asset, we use depreciation. Then to make provision for replacement for an asset. So when, for example, if you buy an asset, for example, you buy a machinery for $10,000, and after 5 years, you know that, of course, you're going to replace it because maybe you do some work that the machine wants out really easily. So in that case, you should have an estimate that how much profit or loss I'm going to make by replacing the asset. So in a way to know before, so there's nothing unanticipated that comes up when you sell the asset, it's really important to know the price of the asset. So for that provision, we do depreciation. So there are three main methods of calculating depreciation. So first one is straight line method. So a fixed or equal amount is to be changed as depreciation every year during the lifetime of the asset. The amount of depreciation remains equal from year to year. So every year there's a fixed amount of depreciation we do. So for example, if I buy an asset for $10,000, I think that there should be 20% of depreciation. This is 2,000. So I am going to depreciate my asset every year for $2,000. So it's of a sort of an equal payment done over the period we feel like this would be the life of the asset. Then we have the reducing balance method, a method in which depreciation is calculated at a fixed percentage rate of the book value of the assets. So in this straight line method, we did have an equal amount every year, which is $2,000. But in the reducing balance method, it's 20% year. So in this example, it would be like if I buy a machinery for $10,000 and then I reduce it by 20%, so the value of the asset would be $8,000. Next year, instead of using 10,000 as the principal amount, I would use 8,000 the principal amount. So this is the difference between straight line method and the reducing balance method. And then we have revaluation method. So it adjusts the asset's value based on its current market worth, spreading reduction in value over time for accurate financial reporting. It ensures that the asset's book value aligns with its actual value in the market. So straight line method and reducing balance method, it depends upon accountant to accountant, business to business. how much you want to reduce. But when we talk about revaluation method, we use the current market value of the business. We see the worth of the asset in the market, and then we do the calculations required. So we are in this video going to focus on ledger accounts and the journal entries for the provision of depreciation. So before that, let's see how to calculate the straight line method. So first, we're going to take the cost of the asset. We are going to reduce it with the estimated residual value, and we're going to divide it with the useful life of the asset. So if there's a question coming up in your exam about straight line method, you don't have to worry because cost of the asset would be given, useful life of the asset would be given, and also the estimated residual value of the asset would be given. You just have to put the formula in. And if you're wondering what your residual value is, it is the estimated worth of an asset at the end of its useful period. So, for example, I bought something and I feel like after 5 years, I have to replace my asset. And I feel like by the end of the period, I'm going to stop using it. The value of the asset will be around $5,000, which is what I feel like. So, that's the estimated residual value. So let's look at an example over here. Sarah purchased a delivery van for her business at a cost of $25,000 on 1st January 2024. The van is expected to have a useful life of 8 years with a salvage value of $3,000. Calculate the annual depreciation using the straight line method and provide a depreciation schedule for the first 3 years. So Sarah purchased a delivery van, which is for $25,000 on 1st January 2024. It's when the new accounting period starts. The useful life of the asset is 8 years, and then we have salvage value. It's same as residual value. It's nothing different. That's $3,000. So Sarah thinks that if she have bought the delivery van today, which is 1st January 2024 for $25,000, she believes that after 8 years, she might have to sell it for $3,000. So that's the salvage value or the residual value. So let's see how she's going to work with straight line method. So on 31st December 2024, what she's going to do is she is going to use this formula for a straight line method. So she's going to reduce $25,000 from, she's going to reduce $3,000 from $25,000. And whatever the amount is, she's going to divide it by 8. So she's going to get 2,750 as the depreciation. If you see on this side, you would see accumulated depreciation. So we're just adding the depreciation of all these years. It's just the sum of the years we have been calculating depreciation. So this is a straight line method, which means that the amount would be same every year. So on 2024, we have 2,750. On 2025, we have 2,750 again, because the amount is going to be same. Cumulative depreciation is nothing, but it's due 750 plus 2,750, which is 5,500. And then in 2026, again, she's going to have 2,750 because it's going to be same across all the years until 8 years are done. So this is the addition of these two. This is the addition of these three, and this is nothing complex. So let's see what the journal entries are going to be in the books of Sarah. So on 31st December, we are going to have provision for depreciation on the debit side. Since it's an expense, so it's debit. A delivery van is on the credit side because we are reducing the value of the delivery van in its account. So if I buy one more delivery van, it would be debit because assets are always debit. But here, since I'm reducing it, so it would be credit, and expenses are always debit, so I'm going to have depreciation. Provision for depreciation seems to be a really fancy word. You can always use just depreciation, but I have used provision for depreciation here. So it's going to be the same entry every year. So in 2024, we have debit 2,750, credit 2,750, same for 2025, and same for 2026. We're going to repeat the same entry for recording depreciation every year until 8 years are done. Now we're going to see the provision of depreciation account. So this is in the books of Sarah. This is how the ledger account for depreciation looks like. It might seem a bit complex to you, but that's really, really simple. So since the expense is a debit, so we're going to go to the debit side of the depreciation account. So on 31st December 2024, we had a delivery one, and we have put a depreciation for 2750. On the other side, we're carry forwarding it so that debit balance and credit balances are equal. So I took this balance, I carry forward it to shift it to the next year. The books are balanced. Now, this balance in the next financial year is presented as brought down method because the accounting for 2024 is done and I'm going to start with 2025. So I'm going to bring this thing here. So the balance brought down is 2750. That's already there in the provision for depreciation account. And on 2025, I put the entry again for the delivery one depreciation, that's 2750. Now the sum of 2750 is 5500 to balance both of that. Now this accumulated depreciation goes to the next year. So this is how you're going to record the provision for depreciation in the account. And if you guys have any questions related to what is done, please don't hesitate to comment in the comment section below, asking any questions you have so far or in this ledger. I'll be more than happy to explain it to you. Now, let's look at the delivery van account. How is that going to look like? So, first of all, on 1st 10, 2024, I bought the delivery van for $25,000 for cash. So I did put an entry that I did purchase a delivery van. On the other side, I'm going to put the depreciation, which is reducing the value of the delivery van. And I have to balance it. So to balance it at the year end, I will write balance carry forward, which is CF. And the total of this side is, of course, $25,000 because we don't have anything on the debit side. On the credit side, we did reduce by 2750. Now, this means the value of the asset at the end of the year is 22,250. I'm going to bring this value to the next year and then use the depreciation again for 2025. And then to balance it, I would do balance carry forward, and the value of the asset would be 19,500. Now let's have a look at the reducing balance method. On 1st October 2013, Natasha Salim started a business altering and mending clothes. On that date, she purchased the machine $4,000 paying by check. She decided to depreciate the machine using the reducing or the diminishing balance method at 20% per annum. Prepare the journal entries and ledger accounts for depreciation and machine for 2 consecutive years. So we have to prepare the journal entries in the books of Natasha for 2 consecutive years and also show the ledger accounts. So to work things out, I have calculated the depreciation. So the year starts at 1st October 2013. It means that it's going to end next year, which is 30 September 2014. So the price of the machinery was $4,000. So we're going to have the 20% of $4,000. So that's really simple. That's 20 divided by 100 into 4,000, which is going to be 800. So the value of depreciation would be 800. But since we are doing the reducing balance method next year on 30th September 2015, I'm going to do 4,000 minus 800. Why 800? Because it's reducing balance method. So what we do is we reduce the value of the asset every year, and then on the base of that, we do the calculation. On the other hand, the principal amount every year was same in the last question. But in this question, the value is going to change every time. So the new value in 2015 The value of the asset was 4,000 minus 800, which was 3,200. Now I'm going to calculate depreciation on 3,200. It's going to be 20% of 3,200 is equal to 640. Next year, I'm going to do 3,200 minus 640. So it's really easy. What you have to do is take the value of the asset, reduce the depreciation. Then next year, you have to take the reduced amount and then decrease the depreciation. Then take the reduced amount and then decrease the depreciation. So you have to keep doing it. Now let's see the journal entries for depreciation in the books of Natasha. So on 30th September 2014, so that's exactly the same. The entry is not going to change. Depreciation is an expense. Expense is always debit, so it's going to go on the debit side. However, we are reducing machines, so it's going to go on the credit side because when we do assets credit, they reduce. So the first year, the depreciation was 800. Next year, we're going to do the same entry provision for depreciation account debit to machine. Debit is going to be 640. Credit is going to be 640 again. So the amount of depreciation is going to reduce every year, but on the other hand, in straight line method, it was same. Now let's look at the account. The account is literally the same. You take the machinery, we had the depreciation for machine for $800. To equal that, we have used balance carry forward, 800, 800. Let's move to next year. We brought down the balance of $800. And then this year, the depreciation was 640. So 800 plus 640 is 1440. To balance it, it's going to be 1440. So that balance is going to be carried forward. So since we had to show depreciation for 2 consecutive years, so we've just shown for 2014 and 2015. Let's look at machinery account. So it was told that Natasha bought the machine via check. So we're gonna add bank here. So machine was bought on bank for $4,000. The value was reduced by $800. To balance it, we had 3,200. That was carried forward. And then again, next year we did it for 640. Then we to balance it, we had a 2560, and that was taken to 1st October 2015. So it's really simple as straight line method. It's just that the value is a bit different. The way of calculation is a bit different. Just everything is same. We're gonna also talk about revaluation method. So a hotel purchased crockery on 1st January 2015 for $1,500. On 31st December 2016, it was valued by a chef at $1,250. In 2016, the hotel purchased more crockery items for $2,000. At the end of the year, the stock of crockery was valued at $2,850. Calculate the amount of depreciation to be charged for 2015 and 2016. So the way of calculating it is really, really simple. So what we have done is to calculate the value of depreciation. So the thing is, in revaluation method, we are given the amount at the end of the year and at the start of the year. We just have to find the value of the depreciation. You don't have to find the value of the asset because it's already given that it's 1250. We just have to calculate the amount of depreciation. So it's simple math. I'm going to take the book value on 1st January 2015 and reduce it by 31st December 2015. So it's start of the year minus end of the year. So it's 1500 minus 1250, which is 250, is the depreciation for 2015. Now let's look at depreciation for 2016. It's the book value on 1st January 2016 because we did have the inventory last year. We're going to add the purchases of the year, which is like $2,000. And then I'm going to reduce the value of the crockery at the end of the year, which is 250. So it's 1250, which is this value. We're going to add 2,000, which is this value. Reduce it by 2,850, which is the year-end value. And we're going to get a depreciation that is $400.